Welcome. This is Finance 331 Applied Investments. This is an introduction to class preparation assignment number 7. We're going to cover a lot of separate topics here. One is give you an example of portfolio rebalancing. Also, turning your human capital into equity capital, why that's so important. Dauber's qualitative analysis of investor behavior, is it accurate? It's something that's often referred to by financial advisors. Behavioral biases and how to counter them, which is really the focus of class preparation assignment number 7. We'll discuss strategic and tactical asset allocation, and something that's very meaningful in today because we are experiencing what many would call a black swan. So we're going to do a preview of Larry Swedo's book that you'll be reading, How to Reduce the Risk of Black Swans. And we'll discuss valuations and where do they stand right now. And can we really accurately measure stock market overvaluation, undervaluation levels, and predict long-term future returns? All right. First, let's discuss portfolio rebalancing. All right. Here's a sample of the chart that you will likely see on the exam with some additional columns that we'll study later. Here are different asset classes. U.S. large cap stocks, just generally, might represent that by the S&P 500 index. U.S. small cap value stocks, international developed market small cap value stocks, and international emerging markets value stocks. And as you get into studying How to Reduce the Risk of Black Swans by Larry Swedroe, what you do is actually recognize that this is very much the Larry portfolio, it's called, with some minor adjustments. And then a U.S. Treasury bond fund has a duration of only 2 to 3 years, a fairly short-term treasury. Now we can hypothesize that there's some expected asset class returns here, and I just put up what might be the historic range of returns for these asset classes, maybe a little bit lower than that in the case of U.S. stocks. And then we want to try to figure out if we're allocating 10% to the asset class, when should we rebalance? When stocks go down in value, when this asset class goes down in value as a percentage of the entire portfolio, when should we rebalance? And also, when should we take gains off the table and sell? And how do we do that for each asset class? Well, one of the ways of establishing rebalancing targets, and it's the way that I favor, is to basically multiply 0.8 times your target, whatever your target percentage for that asset class is, and that will give you your lower limit for rebalancing, and also multiply 1.20 times the target, the higher limit. That's essentially minus and plus 20% deviation from the target asset allocation that you've got. And then for fixed income, you can do the same method, or you can use the Larry Swedroe's method that he wrote about 20 years ago, and it's a method that I use, which is for whatever the fixed income allocation is, just subtract 5% or add 5% on it. What you find over the course of time is most of the rebalancing in a portfolio comes from rebalancing when the fixed income allocation gets out of whack, because stocks, generally speaking, go up and down fairly close. They have a strong correlation, but fixed income has a much weaker correlation to all of the stock asset classes. And as a result of that, most of your rebalancing is going to be triggered when the fixed income allocation gets out of whack. So just to see what this would be, if we take the 10% allocation here, we go times 0.8. 10 times 0.8 is 8, and 10 times 1.2 is 12. Same here, 30% times 0.8 is 24%, 30% times 1.2 is 36, and we do the same for these two asset classes. But then for fixed income investments, we could do the same, or we could say 20 minus 5% equals 15% for the lower limit, or we could say 20 plus 5% equals 25% for the upper limit. And here is the expected asset class return. And we can also compute the expected contribution to the portfolio's returns. We've done this previously. You just multiply this times the expected return, turn this to a decimal, so instead of 10, make it 0.10, 0.30, 0.15, multiply like 0.10 times 8 equals 0.8. And then you can also figure in a rebalancing bonus. We'll study that very briefly soon. And you get the expected gross return, but then you have to subtract some fees and costs, including that nice fee that the investment advisor gets paid, like the bear. And then, although my fee is actually lower than that on average for my clients, and then we get the nominal return for the portfolio, and then we want to maybe keep that portfolio growing. If somebody's taking money out of the portfolio and they're an early retiree, we probably want to keep that portfolio growing at a rate equal to inflation. Typically, retirees want to pass along their net worth to their heirs, to their children and grandchildren, and therefore they want to have that portfolio keep pace with inflation. Plus, if you don't keep pace with inflation, and someone has a real long retirement, 30, 40 years, you could easily run out of money. So we subtract whatever we think the inflation rate is, and then over a long period of time, and then we come up with the expected real return of this portfolio. Now, this is a fairly aggressive portfolio here. Only 20% fixed income, so that's not something that you would see a retiree use. A retiree would use something much more conservative than that. Let's turn now to turning your human capital and equity capital. We discussed this a little bit before, so let's just review this. Your goal is financial freedom, which means what? It means you don't have to work anymore. You can work because you want to, but you don't have to work anymore. And in order to do that, you have to generate an income stream for yourself that is not dependent upon employment or working for yourself. And to achieve financial freedom, you really have to start figuring out how much money do you need to accomplish this goal. A rule of thumb is whatever your income need is, multiply it by 25 or 33, somewhere in that range, depending on what you project future returns are going to be. And at this point, it also is somewhat affected by taxes. If you have most of your investments, for example, in 401k accounts, traditional 401k accounts, traditional IRAs, you'll probably want to use the higher number, 33x. And then you have to figure out from there, once you figure out your money, what is your savings rate, you also have to project how long until you want to achieve financial freedom. We might call that the date of retirement, although a lot of people achieve financial freedom and don't necessarily retire. And you also have to do some projections on rate of return. So, what is retirement? Well, one of the things that we've talked about is, and we discussed this a lot in the retirement planning class, is retirement is really a relatively new concept in the United States. A lot of when people were actually forced into retirement in the 1900s, there's a big rebellion against that, and they really had to sell the idea of retirement as this golden period of time, and you got to watch upon retirement and the like. What I like to say is that regardless of whether you're retired or not, you want to accomplish certain things in life. So I asked a 5-year question of all of my clients, and also I think it's a great question to ask yourself. If a doctor told you you had 5 to 6 years to live, and during that time you'll be as healthy as you are now, or in good health, what would you like to do or accomplish so at the end of that time you have no regrets? What would you like to do or accomplish so that at the end of that time you have no regrets? And when you answer that question, you have to get fairly specific with it. For example, somebody says, I want to travel. Where? I want to go to Europe. Oh, where in Europe? I want to go to Paris or London. Okay, what do you want to do there? How long do you want to stay there? Who do you want to go with? How do you want to get there? Questions of that nature. A lot of the answers are about travel. A lot of the answers are about spending more time with family. So how would you like to spend more time with family? For example, I had a client once. Her husband had passed away. She was, about 80 years old or so, a little older than that perhaps. Her children were actually relatively young. She waited a while to have children. She had a significant sum of money, but her children were spread up and down the East Coast. She lived in Florida, and she had grandchildren, and she didn't see enough of them. And I said, this is like October of one year, and she said, I'd love to go see them, but they're so busy. They lead so busy lives, and I'd love to get everybody together, but it just doesn't seem like it's going to happen. And that for her was her big bucket list item. So what we did was we had her rent a 10-bedroom home on Hilton Head Island in July of the following summer and invite all of her children. And she said, "Oh, I don't think they'll come." And of course, they did come. They had a great time. They did that for several years before the client passed away, and something that was very meaningful to the entire family. So remember, relationships are important. So, rule of thumb is how much money do you need to accomplish financial freedom? Basically, this ability to retire, not work anymore, not necessarily retire. And then you need to figure out what your years to retirement are and adjust the amount of income you desire for inflation. So you use some calculators here to basically adjust the income you desire for inflation. You're going to have to assume an inflation rate. So here's an example. If you project that you desire $100,000 a year in income in retirement, that's in today's dollars, net of taxes, and your Social Security retirement will commence at age 70 and bring you $30,000 a year. Now that's about the average Social Security check. And being a college graduate, you should be earning a lot more, and your retirement check should be much bigger than that, I would hope. Um, Actually, that's above the average, 30,000 a year. The average retirement check is around 1,600, 1,700 a year, about $20,000 a year. So maybe this is about appropriate for the average college grad. Hence, you need an additional $70,000 of income in today's dollars, and you need to adjust that for inflation. If you're going to retire by 40 years, you put into the inflation calculator, and you find out that to have the same purchasing power, you would likely need $228,000. All right, and then you multiply that times 33, and that's the amount that you need to save, assuming that future rates of returns are either low or that you're saving mostly in 401k accounts or similar types of tax-deferred accounts. All right. How much will it take to save that? We can use a different calculator. And for example, if you make $50,000 a year and you increase your pay at 4% a year, and if you save 18% of your gross pay, and if you earn 11% a year on your investments, which is possible, especially after taking this class, then you would have $8.6 million at the end of 40 years, and that just happens to be even more than the 7.5. But again, the key is you need to start saving early. If you wait a year, you'll probably wait another year, then another year, and so forth. You need to start saving 18% of your gross pay the instant that you begin full-time employment, without exception. All right, and it doesn't take you 18% of your gross pay because you were getting an employer match of some type, hopefully 3 or 4%, maybe even higher. That will take care of some of that. Any debt reduction, the principal amount, not the interest, but the principal amount of debt reduction counts against that 18% because you're increasing your net worth. And then on top of that, principal payments on a mortgage, which is also reducing debt, and also if you contribute your funds to a traditional 401k, traditional IRA, you're going to get a tax deduction for that, which means you have more money in your take-home pay. So it doesn't necessarily mean 18%. For a lot of people, that might be 10 to 11% of their pay, their gross pay, is actually going towards savings after you take into account employer matches and the tax benefits. But should retirement be a goal? Yeah. This man wants to know, I want to know the meaning of life. And the wise sage says, have you tried Googling it? What's your purpose in life? And what you find is when you identify a purpose in life, and for me, I didn't identify a purpose in life until I was probably about 40. Yeah. In terms of a purpose in my life that has sustained me to this point. Fulfilling that purpose is what gives your life meaning. Of course, having the bucket list, that 5-year question, and maybe break that down. These are things I want to do before I have children. These are things to do when my children are young, and these are things to do when the children are out of the house. So you need to enjoy the journey along the way, not just save everything for retirement. Let's turn to another subject, Dalbar publishes something called the Quantitative Analysis of Investor Behavior. And what it shows is that the average investor earns significantly less than just the market. For example, they suggest that over a 30-year period, the average investor, in terms of investing in equity funds, earns only 4% a year, compared to the S&P 500 index, which has earned 10% a year. And uh, that for fixed income investors, the same thing, very low rate of return compared to just an aggregate bond index and the like. And even over a 12-month period, they also show that investors underperformed. And they do a computation for this. This is based on one that was done back in 2016, but they do publish this every year. So basically, what the study concludes is that investors cause their own demise. They basically act incorrectly. The average equity fund investor underperforms market indexes by 8%. Average fixed income investor underperforms by 4%. There is some truth to this study, but in other respects, the computations used in the study have been criticized a lot. I'm a member of several discussion boards for basically financial advisors, investment advisors, and on those discussion boards are some fairly detailed discussions of this. But despite the fact that the Dalbar's QAIB basically overstates the fact that investors underperform so much. They basically investors underperform, but not as much probably as the study suggests. All right, but we do know that investors underperform their benchmarks, and why? Well, one is fees and costs. Many mutual funds, the costs are much higher than they need to be, and we have seen a big transition away from high-cost actively managed funds into low-cost index funds or passively managed funds. But probably the biggest thing is selling low and buying high, the exact opposite of what you want to do. You know, one of my favorite 4 words in investing: buy low, sell high. Yes, we can see this in mutual fund inflows and outflows. For example, here's a chart that goes through August of 2015, and it shows some interesting things. Here it is, the market has gone up, all right, and as the market has gone up, more money comes into mutual funds. Market goes down, more money comes out of mutual funds. The most money coming out where it's near the bottom. Market goes back up again, and as it's going up, more and more money comes in. Then the market goes way down, and look at all the money coming out while the market has been down, and then it goes way back up and the like. So I looked this up on just today. For the week ended March 25th, which was yesterday, I believe, all equity funds. Now, the stock market has gone down about 30%. The U.S. stock market, 30%, maybe even a little bit greater than that, since its high in January. And last week, the market did terrible on Monday, did really well on Tuesday, Wednesday, Thursday, kind of made up the losses that were felt on Monday, and then fell back a little bit on Friday. Because the market had gone down so much on Monday, people fled stocks. All right. After that, they started pulling money out of their portfolio. 16 billion came out of stock funds, and taxable bond funds, corporate funds also saw a lot of outflows. Money market funds, which are real safe, 259 billion went into them, and municipal bond funds also reported outflows because people are a little bit scared of the impact on state and local budgets because of all the coronavirus. So we can actually track fund flows on a year by year or even week by week basis, and see that funds, when the market goes down, more people basically sell, and when the market goes up, after it goes up, more people buy. The exact opposite of what people should do. Now, why do people behave so irrationally? Right? Well, it's subject to some behavioral biases that we all have. For example, this guy has a lot of behavioral biases. So got to really be careful of this guy. All right. So behavioral finance is basically this field of financial theory that attempts to further understand securities prices and how people, including how investment advisors, actually manage investor portfolios by understanding investor behavior. One of the things I've had to do opportunity to do is actually start listening to podcasts. Not something I normally do, but as I'm doing my hour-long and longer walks, I found that hey, I can use this time productively and listen to podcasts. And I listened to an incredible podcast. It was basically an interview of Eugene Fama, Senior, who uh, and David Booth, and they were talking about a lot of the concepts here. And Eugene Fama is very skeptical of behavioral finance, and his colleague at the University of Chicago, Richard Thaler, is basically the main guru in behavioral finance. So it's interesting that they golf together and things like that. But in my mind, we can have very key insights from behavioral finance. So, from the standpoint of how people react to what the market's doing, and can we change their behaviors, not just about the market, but change their behaviors about money in general. Let me ask you a question. If your portfolio amount, the initial amount in your portfolio is $300, which would you choose to have? A, you will have a sure gain of $100, or B, you will have a 50% chance to gain $200, and you will have a 50% chance to gain zero. Which of those would you rather have? A sure gain of $100, or B, 50% chance to gain $200, or a 50% chance to gain zero? All right. Now let's ask the next question. Suppose your initial portfolio amount is $500. Choose one of these. You would either have a sure loss of $100, or a 50% chance to lose $200, or a 50% chance to lose zero. Which of those, C or D? A sure loss of 100, or a 50% chance to lose 200, or a 50% chance to lose zero? Got that in your mind? All right. What we find is this study has been done very widely, and in case one, 72% choose A. They would want that sure gain. All right. But in case two, only 36% chose C, a sure loss. They're more likely to gamble in that case. Why is there a reversal in choice? Well, it all relates to framing, how you frame questions. And one of the things you always have to be suspicious when people do polls is how are they framing the questions. And it's nice to see that, for example, 538, which is basically an election prediction firm. It predicts a lot of things. They actually will look at political polls, for example, and rate them on how well they are from like A, B, C, D, and stuff like that. So, but you always have to be, when you think about when people ask questions like polls, how are they framing the questions and are they framing it correctly? All right. When the problem is framed as a gain, a decision maker is risk adverse, but when a problem is framed as a loss, the decision maker, the investor, is risk seeking. So basically, when interpreting all the information out there, humans look for this framework of similar experiences. And let's go on and just kind of review what is the difference between traditional finance and behavioral finance. Traditional finance, people are rational. They're fully informed. They make choices consistent with their expected utility, with what's in their best interest. And they do that logically, yes. Behavioral finance, some people sometimes are not fully rational, like Simpson here, as opposed to Spock, who is completely rational, or at least mostly. Yeah. So what stops people from acting, especially making decisions about investments? One is a lot of people just don't understand investments very well. Uh, it's not something that they focus their lives on. Uh, they don't know who to trust a lot of times. And there's obstacles to overcome and try to understand that information. A lot of information they need to know to really understand the capital markets and how they work. They don't have the advantage of taking applied investments, for example. So, another obstacle they have is proliferation of choice. There might be thousands of mutual funds out there, and they don't know which one to buy. All right. Shoppers in an upscale grocery store encountered tasting booths for jams. If there were only 6 jams, 40% of the people stopped, but 30% bought. Uh, 24 jams, however, a lot more people stopped, but only 3% bought. That's because there were so many choices. And nowadays, they really learn from this. When you encounter those tasting booths, they basically just give you one item as opposed to several at that point. Applied to investments, 401k mutual funds, there was a study done, and several studies done back in the early 2000s, that for every 10 additional mutual funds that you put on this 401k platform for investors to choose, investors' participation probability declined by about 2%. The result of that is nowadays, most of the time, you'll see about 10 to 15 different mutual fund choices, plus something called target date funds, where somebody says, I'm going to retire in 2065, and it's one fund that automatically adjusts as you get older the asset allocation. So you have what I call target date funds, and then you have about 10 or 15 other funds. I'm actually fairly critical that you have such a limited number because there's a lot of different asset classes out there, and a lot of times when I'm designing portfolios for clients, I'm really limited by the choices in their 401k. And in my mind, there should be probably, in many of the well-run 401k plans that I've seen, I still would like to see another 5 or 6 different fund choices. All right. So here's the question we actually asked in class. Above average drivers, are you an above average driver for someone of your age, average or less than average? And what we found is that if we look at all the answers, most of you, the majority of you, way over 50%, say that you're above average. And the reason for that is people have overconfidence in their own abilities. Right? And this has been done in many sectors. Company CEOs, doctors, lawyers, students, of course, and doctors' patients all tend to overrate their abilities or the accuracy of their views of what's going to happen in the future. So basically, we have this faith in our own intuitive reasoning and our judgments, and it's good to have faith, but we have to also guard against being overconfident. And investors are often overconfident in their ability to select stocks and to time the stock market's ups and downs. For example, sitting right here, I can tell you I have a very firm belief that the coronavirus, the impact of that has not been fully felt by the economy, and that investors overall are underestimating its effects. And as a result of that, I think the economy is going to be far worse than what generally people think over the next several months. And I also think that the stock market's going to decline. Wow, look at me. I'm predicting the future. I'm predicting the near term future of the stock market. Having said that, am I going to gamble my clients' money on that? No, because I might suffer from this overconfidence bias. Now, there's some other reasons behind that very long explanation, but basically, what I have found is that if you establish that plan in advance for what you're doing and you follow that plan, there's a huge amount of academic research that strategic asset allocation and rebalancing works. Basically, it forces you to buy low and sell high, never knowing if things are going to go lower or if things are going to go higher. The overconfidence bias can also lead to too much trading. People chase returns and sometimes they lack diversification. They'll say, wow, I really think Apple stock's going to do great and I want to buy Apple stock. Yeah. So they have an overconfidence bias that they have some unique insight that all these other people don't. And we'll be studying the efficient markets hypothesis in a later class preparation assignment. So overconfident investors overestimate their ability to identify winning investors or when to get out of the market. You'll see this with day traders, people who actually go in and follow the market, the movements of a particular security, often a stock, and will trade in and out of it in the same day and try to make money. I have got to say this about day traders. One is they tend to be very confident in their abilities. There are several who have made money. I have never met a day trader who day traded for 5 years and has not filed bankruptcy. Think about that. Yeah. People become overconfident in their own abilities, they make money, and they make mistakes. Day trader is a sucker's ploy. Don't do it. All right. Overconfidence, as we studied previously, might be behind the investment factor. The fact that a chief financial officer is looking at budget projections for where to put money in different projects or acquiring another company and the like. And they might be overly optimistic. There might be some overconfidence bias going on in terms of the ability of themselves and their company to achieve those desired results. And budget analysts working at companies probably suffer from that overconfidence bias as well. So for that reason, we like to say that CFOs often make dumb decisions. Yes. We have a self-attribution bias that's basically related to overconfidence, and basically it says when something good has happened, you say, hey, that's because I made a good decision. But if something bad happened, that was just bad luck or misfortune. Yeah, for example, students, hey, I'm so smart, I got an A. You take credit. But if you got a bad grade on an exam, oh, she doesn't like me. The bear doesn't like me. Oh, yeah, you blame external factors for those negative events sometimes, as opposed to taking responsibility. Yeah. Uh, Confirmation bias is another big bias out there. Basically, when we all of us are susceptible to the fact that we have certain points of view that have been drilled into us by other people, that is a result of our own experiences. It's our view of the world, and we tend to look for facts that endorse our view of the world. For example, a student who's going to write a research paper might search for information that would confirm the thesis, uh, whatever they're trying to prove, and may fail to fully consider information that is inconsistent with those beliefs. And I have that flaw too. I will do research and public policy work, and I'll be researching, and I'll tend to ignore uh, statements or legal research or other research that contradicts the conclusion. A really good way of countering this is to force yourself to argue the other side. Take the other position for a day, do research trying to prove that position, and that's a good way of countering confirmation bias. This is the confirmation bias cycle. Probably somebody reads the research. Do they agree with the findings? No. They find a reason that the research is flawed and they ignore it, or they agree with it, but then they ignore any flaws in the research. So they keep their own worldview in essence. Yeah. This gentleman says, I've heard the rhetoric from both sides. Time to do my own research on the real truth. And they Google, and literally the first link that agrees with what they've already believe is the link that they click on. And just another way of saying this, there is a whole set of objective facts out there, and unfortunately in today's world there's a lot of misinformation as well. And then you have this information that confirms what you believe, and what you see is somewhere, what you actually see and act on is hopefully is something that's in between. Yeah. Another example of this is conspiracy theorists. Basically, they see evidence that fits the conspiracy that they built up into their minds. So again, just to say this, one of the things we hope that you get out of college is critical thinking, and one part of critical thinking is the ability to question what other people are telling you. One of the things I do, especially in political times like this, I'm very interested in the economy. I'm interested in politics from a distance, we'll say. I follow that, and I have a unique set of beliefs, probably compared to other people. I'm probably more socially liberal than many people in this area, and people my age, but I'm also more fiscally conservative than many, uh, in terms of the economy and government spending and things like that. Uh, so uh, I don't feel very like I identify with either political party very much. Uh, identify with parts of each position. So one of the things, I guess because of that, is I try to look at for different sources of information when it comes to politics and comments about what's going on in the economy as well, because economic thought can be influenced by political beliefs. And I'll look for people who have different views. I'll look for people who are conservative as well as those who are liberal. And you might say that the media, for example, is biased by and far to liberals, and I think there's some truth to that. Uh, Many media outlets are biased liberals, but there's some that are very much biased extreme conservatism. Uh, and what I try to do is actually listen to all of it. So I'll listen to Fox News, and then I'll turn the channel and listen to, I think it's MSNBC, and then I'll listen to CNN, and then I'll read. And when I go online to read, I try to ignore all of those sources, and I try to go to like BBC News, and also some other overseas publications that are looking at the U.S. and from their view, which tends to be different. But you also find that here in the United States, our news is very much focused about the U.S. And if you really want to discover what's going on in the rest of the world, sometimes you need to go to foreign news sources. Fear of loss, huge behavioral bias. People are much more sensitive to a loss than they are to gains. In fact, uh, some people say that, hey, when people have a loss, they're twice as emotional about losses. Consider an investment that somebody bought for $1,000, which rises quickly to $1,500. By the way, that happened in the last couple of years. All right, someone who put $1,000 into the stock market a couple of years ago, 2 years later, they had $1,500 somewhere in January. All right, the investor would be tempted, but in contrast, if that $1,000 had dropped to $500, the investor would tend to hold it to avoid locking in the loss. Oh, that's just a paper loss, they would say. The idea of a loss is so painful that they tend to delay recognizing it, despite making a decision as to what might be prudent going forward. Right? The pain from loss is much greater than the pleasure from gain. And here's a nice chart. Basically, it says, what is the average return of the past 3 years, and what's the average return this year? It's negative about 30% year to date. I'm losing money, would be the investors. What should I do now? People forget that they had a lot of great returns, in this case, over a 10 or 12 year period of time. In fact, here's a chart through Friday, and let's see, today is the 28th, so for Friday, March 27th, and it shows, wow, the market has gone way down uh, very sharply recently. So that pain is sudden, it's severe. But if we look back, the market isn't really that much lower than it was. Here it was late 2018. Yeah, just a year and a half ago. And here we are, the market's right where it used to be back in 2017, towards the end of 2017, just a couple years ago. And the market used to be a lot lower than that back in beginning of 2016. So people are saying, hey, that's 4 years ago, and the market has gone up from here to here. If people would be quite happy if the market just did a straight line up to here. They'd be saying, hey, that's pretty good. That's maybe 8-10% a year in terms of the rate of return. But, and this is a price only index, it doesn't include dividends, which typically run about 2 to 3% a year. So this is, but because the market did this, when the market goes down, here's the big fall at the end of 2018. The fall of 2018, the market fell fairly significantly. People were experiencing pain at that point, and they've really been experiencing pain here. Recency biases everywhere. Everywhere. Yeah. We also have herd mentality. Think about this one. I've got a stock here that could really excel. Really excel? Excel. Sell, 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 sell. Sell, 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 sell. This is madness. I can't take it anymore. Goodbye. Goodbye. Bye. 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 Yeah. Yep. They've herd mentality. Just a normal day at the nation's most important financial institution. Not really, of course. All right. What can you do to counter your own behavioral biases? One is this: you need to understand them. All right, you need to understand them, and you basically need to have a plan. And what was that plan called? Investment policy statement, strategic asset allocation. When are you going to rebalance a portfolio? Stick with that discipline through thick and thin. Yes. You also need to be humble. All right. Humility is something I have to practice a lot, right? Because if I think I know a lot, and I think I do know a lot about how to value stocks and the market generally and the like, but I need to be humble when it comes to this. Right? You need to make those pre-commitments. You have to have that plan. What are you going to do if the market goes up? What are you going to do if the market comes down? And that plan, of course, is the investment policy statement. You need to stick with that plan. Yes. So let's discuss black swans and how to reduce the risk of black swans. Well, I want to reveal to you my investment secret. Dum 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 dum. That's right, I have a crystal ball. I actually do have a crystal ball, an actual crystal ball. I wish we were in class. I would bring it out and show it to you. It's 5 inches. It's very heavy. Yep, and I tend to look at that, and I can look into that crystal ball, and I can tell you where interest rates are going, whether the stock market is going up and down, how the economy is going to do it. And because I have this crystal ball, I have these unique insights that make my money for a lot of my clients and myself. Now, actually, the one problem with my crystal ball is this: it doesn't work. Yeah, and in fact, nobody has a crystal ball that works. Wall Street does a lot of marketing convincing you that their firm has the ability to outperform the market, but they don't, especially after charging high fees. So nobody has a crystal ball that works. Now you might say, well, wait a minute, there are mutual fund managers out there who do really, really well. And there'll always be mutual fund managers that do really well. Imagine 10,000 people standing up in a room, and they're all given a quarter. And they flip that quarter, and if they get a heads, they get to remain standing, but if they have a tails, they have to sit down. All right? After they flip 8 or 9 or 10 times, typically at that point, there's only 3 or 4 people standing in that room. All right? Are they lucky, or are they good? Are they just really good? Are those the people who outperform the market? And the fact of the matter is, you can't tell the difference between luck and skill until you have about 40 years worth of data, according to some studies. Yeah. Now, I'm sure there are skillful people out there, but the problem I have is I have no idea who they are. And the fact that somebody outperformed the market over a 1 year period or a 5 year period or a 10 year period, what we also see is that on average, the people who have outperformed the market tend to underperform the market in the next period of time. So it makes it very difficult. What's a black swan? Well, there have been many stock market downturns. All right. In fact, over the last 100 years, there's been about 15 to 20 declines in the stock market that were greater than 10%. That's not a black swan. All right. A black swan event is different from just a market downturn. It is because there's some type of unpredictable event happening that causes a severe disruption. All right. Now, here are large equity drawdowns of more than 20%. They're actually pretty recent and pretty frequent. Cuban Missile Crisis, Vietnam War. We have stagflation in the United Kingdom, and what we have here in blue is the S&P 500. We also have some other indexes here, but we'll pay attention to the dark blue here. Stagflation, the 1987 crash when the market fell 25% in one day, and the Iraq War, the default of Russian debt caused by a firm called Long-Term Capital Management, or actually a result of that was the failure of a firm called that. Bursting of the tech bubble, the great financial crisis, crisis in the Eurozone, and of course, most recently, the coronavirus. Is the coronavirus a black swan event? I think it is. I think that although we knew that we would have viruses that could impair our economy. We had no idea when they would occur or how severe that they would be. And therefore, to me, coronavirus is a black swan event. All right? We can go back way through history and look at other big downturns in local currencies. This is everything from the South Sea crisis to the cotton crisis, here railroad crisis in the United States, a long depression, Wall Street crash, of course, and then other big crashes. 1973 to 74, stocks were down 40 to 45%. Black Monday down 25% in one day, about 35%. The Asian crisis, a significant fall in stocks, not huge, but almost 20% here in the United States. The bursting of the dot-com bubble and the subprime crisis, where stocks on average here in the United States were down 57%. Yeah, let's watch a little video here.
Life's a journey. You know for certain it's starting, but you don't know where. How do you know where you're going? How will you get there? And when? How much is enough to take you there? And how long does it need to last? Of course, nobody can really see the future, but Black Swan Financial Management can help you map a journey towards it. Then, from time to time, we can determine whether you're in front or behind where you plan to be. For further information about how we may be able to help you, please call us on 01344 873 254 or visit our website at www.blackswanmanagement.co.uk.
So actually what we see is a firm called Black Swan Financial Management. They took advantage of basically Nicholas Table's name for his book relating to black swans, and they made an advertisement about it. One of the things I like to think about that video is it sounds like it came from a funeral home in some respects, but interesting marketing technique. If we look at price earnings ratios, the price of a stock relative to its earnings, or the average price of an index of stocks relative to the earnings of all of those stocks, we can actually do PE ratios for an index. All right. Is it based on the last 12 months earnings, or is it based on future 12 months earnings? And we need to ask that question whenever we see PE ratios. All right. So as an example, I'll do this data as of 2018 because right now it's very hard to predict what the forward PE ratios are of companies. Apple, for example, the trailing based on their historical past data of earnings relative to the price as of that date was 19.60, but everybody was, a lot of stock analysts were predicting that the earnings would rise, and as a result of that, their forward PE was 15.77. Microsoft, same thing, huge earnings increase was anticipated. IBM as well. The S&P 500 index, stock analysts overall were expecting that earnings for all of the companies in that index would rise, and you have a lower PE ratio as a result. When looking at forward price earnings, just realize stock analysts are pretty terrible at predicting what's going to happen. They're pretty bad at predicting if interest rates are going to go up and down, and very bad at future company earnings. In fact, CEOs of their own companies find it very difficult to predict what their earnings are going to be in the next quarter. The data on that is pretty astounding, actually. So also, analysts tend to be overly optimistic, and forward earnings on average tend to be about 10% higher than what is actually seen. This is on average over long periods of time. We can compute the PE ratio for the S&P 500 index, all right? And what we can see is some really distorted numbers here. The Great Financial Crisis, huge distortion of numbers here in terms of where the PE ratio went in a very short period of time. So again, we studied Shiller PE or Shiller PE 10 ratio, also called CAPI or CAPI 10. And this is, you can do this for basically any index, but it's most commonly applied to the S&P 500 index. And it's basically the price of all the stocks in that index divided by the average of 10 years of earnings adjusted by inflation. So each of those earnings over the last 10 years is adjusted for inflation, and you get what's called the Schiller PE10. Yep. Why use it? Well, a lot of investment analysts believe that it's a more reasonable market value indication than the PE ratio because it eliminates really these huge outliers can happen when prices rise and fall very rapidly or earnings rise and fall very rapidly or both. So basically remove some of the distortions, and I kind of like the Schiller PE10. I think it does have some interesting predictive value. So the predictive value is over the long term. If you look at this chart, it's what is the CAPE ratio, which is shown on the right, and it's inverted. So if you have a higher valuations down here, then they say what is the future returns in green are likely to be over the subsequent 10 years. And if you have a high valuation, typically the returns are lower, not always. Your higher valuation, lower returns. Here we have a low valuation, somewhat higher returns, lower valuation, much higher valuation, and lower returns over the next 10 years, and so forth. Here's just another way of doing that. It's a scatter chart, and you'll see that there's a correlation there. All right, fairly significant. All right, there are some outliers, but when the CAPE ratio gets here above 40, typically, let's see here, the highest when at the 30 was around 5%. Average annualized return over the next 10 years, that was it, 5% return at 30%. We can do this for different countries' indexes as well. Here's Australia, Germany, Spain, UK, and the like. And we can plot all those out and also see some pretty strong correlations in terms of returns there. Again, to calculate this, and you don't need to know how to calculate, you just really need to understand the Schiller PE10 or CAPE10 concept, that you're basically adjusting the past earnings for inflation using CPIU, Consumer Price Index for Urban Affairs. And you're adjusting all of those earnings to today's dollars, and then you're averaging those earnings out over 10 years and dividing it into the current price, or in this case, the price of an index. So here's just another way of looking at that PE10 ratio. As it has fluctuated over the years, got a very low ratio of 4.8. Here it is right before the Great Depression, 1929, 32.6, pretty high ratio. Up to 44.2 right before the bursting of the tech bubble, and 32 is actually around 33, 34 around January of this year. In terms of where it was, pretty high levels compared to even some of these other peaks here. Yeah. So there are some reasons not to use KP. It's been criticized a little bit. Some by Larry Swerdlow, other by Professor Jeremy Siegel, basically noting that there have been changes in accounting standards. There's another CAPE10 ratio. It's called the CAPE total return ratio that has recently been published by Professor Schiller, and it does make some adjustments in terms of returns and the like. But basically, it looks at, hey, companies are writing off assets a lot faster, and that might affect the earnings. In addition, there's some other adjustments of an accounting nature in terms of computing what earnings are. And as a result of that, maybe the earnings Schiller PE ratio today is higher than it would typically be. What is it as of yesterday, March 27th, 2020? Yeah, it closed at 24 essentially. All right, that is down from here we are at 2000 when it reached 44, and it's down from the peak, fairly recent peak here around 33. And earlier this year, mid-January, down around it was around 31 and a half, 32, somewhere in that range. So it's come down significantly. All right. So, and by the way, the median PE ratio, Schiller PE, is only 15.77. We might call it 16, and is compared to 24 now. We were infer from that that, hey, maybe the market's still 50% overvalued, but it's really not. PE ratios have expanded over time. You can kind of look at this chart and see kind of a little bit of an upward trend here. And there's some reasons for that I won't go into, but basically diversification lowers risk of investing. People understand now as opposed to not understanding like before 1950 that stocks outperform bonds by significant margins over time. At least a diversified basket of stocks does. So there's a lot better understanding of the impact of diversification in a portfolio, the long-term nature of these returns, and that has led people to change their view of risk when it comes to investing in stocks. Also, the ability to diversify using mutual funds and more recently index funds, keeping costs low. Let's talk about strategic and tactical asset allocation for a bit. How does tactical asset allocation differ from strategic asset allocation? Well, strategic is where you lock in your targets. You say, I'm going to have 20% in stocks and 30% in real estate and 50% in fixed income, and they're locked. Tactical says the portfolio manager has some discretion. They might say, well, you can have anywhere between 10 and 40% in U.S. stocks and 10 and 40% in international stocks and 10 to 30% in real estate and 0 to 50% in fixed income or something like that. That's tactical asset allocation. And this is just an example. This is strategic asset allocation where everything's fixed, but you have some ranges where a manager might be able to take this allocation and change it to, if they're bearish on what the stock market is going to do, go down to 48% stocks, but if they're bullish, if they think the market's going to go up to 72%. So it's the type of manager flexibility that might come. Tactical asset allocation, the fees for that tend to be higher. This is a study, this is actually out of a firm's actual chart. This chart may be outdated, by the way. It was at the time that I pulled this. And you can see that the fees for tactical asset allocation are double those of strategic asset allocation. That is not always the case with a lot of firms. Some firms just charge the same amount for tactical as they do strategic. Right. So let's take a look at another video here.
While strategic asset allocation determines the long-term direction for the investment portfolio, tactical asset allocation, or TAA, takes advantage of market opportunities in the short to medium term. We think about TAA daily. We use this as an opportunity to adapt, either to protect an investment where returns are volatile, or to take advantage of a time when value can be added. A good example? Our TAA framework in relation to emerging market shares. Our team identified that the outlook for emerging market economies, and in particular their share markets for the following 12 months, was challenging. This led us to shift our position to lessen investment in emerging market shares in favour of global developed shares, even though other analysts believed emerging market shares to be cheap. The result? By reassessing and adjusting our position in light of market movements and changes in the economic landscape, we added value to the portfolios.
Okay, well that's a illustration of a firm in Australia, New Zealand. I'm not sure you'd be able to do that advertisement, which was done back in 2016, here in the United States, because securities laws and regulations has pretty big prohibitions on something called cherry picking results. All right. But then the question is, does tactical asset allocation really work? So let's pull up another video here. Pretty interesting discussion here from a Morningstar interviewer who is looking at basically, let's see if we can find this video. There we go. All right.
I'm here for tactical
coming to you from the 6th annual Morningstar ETF conference here in Chicago, Illinois. I'm very pleased to be joined today by Fran Canary. He is a senior investment strategist and principal at the Vanguard Group, a thought leader for Vanguard. Fran, thank you very much for joining us today.
Thanks, Jeff. Appreciate it.
So, Fran, you participated in a panel at the conference entitled "Can Tactical Asset Allocation Work?" And so I'll put that question to you directly. Can it work?
Yeah, I think like the active management space in general, active can work. Tactical asset allocation can work. But then you get into the idea of probabilities of success, right? So we do know in zero-sum game and counterparties, mathematically, half can outperform, half can underperform pre-costs, and then after costs, it tends to skew it to where a small minority can work. So if you look at the research and the data, 10, 20, 25% on any cycle have been successful, but then you have to ask yourself, is there persistence?
Right. How can an investor enhance their odds of successfully choosing a dynamic asset allocation strategy? Are there rules of thumb that they could follow?
Yeah, I would think like manager selection in long only or in the regular mutual fund space, you really want to understand the philosophy, the people that are involved, and then lastly, what are the costs to investing in the strategy? So if you really have confidence in the people, the philosophy, and it's at a reasonable cost to overcome the friction, then that would be my criteria.
One of the things you've written about recently is not just the difficulty associated with tactical asset allocation, but also the difficulty associated with investing in such a strategy. Many of them are contrarian by nature, and so it can be difficult to stick with those types of strategies when they hit a bout of adversity. Can you talk a bit about that and some, again, best practices that investors interested in these types of contrarian strategies might want to consider before they invest?
Yeah, I think even if you get the investment part right, so the asset manager is doing a good job, then you have the second component, which is are investors going to stick with it? We do know that markets go through deep cycles, and bull markets don't give you a clear signal as to when they're going to end or when bear markets are going to end. And so by definition, if you're using most valuation metrics, meaning you're trying to buy cheap or sell rich, it's going to be contrarian to what most cash flow is doing and really contrarian to your own intuition. And typically you're going to be early, so you're going to your clients are going to be going into a spot that most others aren't going into. It's probably not going to work for some time. It's going to be against intuition. And so I do think investors have a double challenge here when it relates to tactical allocation is can they hold with it long enough to be successful?
Vanguard at one time had its own dynamic asset allocation strategy. It was the Asset Allocation Fund, which was merged into another of your offerings back in 2011. Can you take us through the thought process that informed the decision to merge that strategy away and maybe any implications that it might have on sort of an investor that was considering a strategy like it for their own use?
Yeah, I would say we mostly were happy with the performance of the fund. The fund was around for over 20 years, actually had large assets under management. And I think the good thing at Vanguard, what we always do is we really are diligent about making sure that our funds still meet the requirements for investor success. At Vanguard, we actually have a core purpose, and that's to give investors the best chance of success. And when we look at some of our funds, even though the performance may be good, we say our investors using this to their own benefit. And after looking at all of that, we came to the conclusion, well, it was a good offer, it had done well, had large assets. We decided it would be best just to go into a strategic asset allocation, so we wound that fund into the balanced index fund, as you mentioned. That doesn't mean that Vanguard doesn't believe in active. So we have a lot of active management, fixed income and equity, but it's more at the security level, where we're really trying to add, making a lot of small bets as opposed to, these directional bets, which if you get it wrong, even in a small 5 or 10% way, can really lead to tracking error.
And why do you think it is that perhaps making tilts at the asset class level is perhaps less hospitable to an active manager than maybe bottom-up security selection would be?
Yeah, I think the key is back to probability theory. If you buy 400 or 500 or 800 stocks and you're plus or minus 10 basis points from its market cap weight, hypothetically, if you get 55 or 60% of them right, you're going to outperform relative to your costs. If you tilt a portfolio, let's say 5% more aggressive throughout the last 15 years or 5% more conservative, the dispersion of stocks and bonds and the correlation of them are so wide. So you end up with even a small bet or a small overweight, underweight blowing out the distribution, whereas in securities, they tend to correlate pretty closely. And so you're getting the overall dispersion down, and we think the best chance for active success.
Gotcha. Last question. Has any of Vanguard's research shown that a tactical asset allocation strategy can perhaps nicely complement a more traditional portfolio allocation to stocks and bonds?
Just like we really believe in active management, if we felt there was a strong probability of us being successful, we probably would implement it. So it's not without a lot of research and a lot of effort in trying, and we'll continue to try. But as of now, we really haven't found that tactical asset allocation makes a lot of sense for our assets in the portfolio.
Fran, thank you again for your time and your insights today.
So interesting. Tactical asset allocation, according to Vanguard, does not make a lot of sense. And for me, it doesn't as well. I think with tactical asset allocation, you have to make two really, really important decisions. One is when to get out or lower your allocation to an asset class, and the other is when to get back in. And what we're dealing with are premiums. If, for example, if you want to get away from value stocks and get into growth stocks, you're going to lose the benefit of that value premium, at least on average over time. So because you're basically giving up that premium, all right, you better be pretty clear that, hey, growth stocks are going to outperform value or vice versa. If you're getting out of stocks, for example, you're giving up the equity risk premium. You really need to make really good calls if you're going to give up those premiums. All right. So, does it work? Well, there's some other problems with it. One is if you're rebalancing in a taxable account, you have a problem with taxes because you're incurring a lot of taxes when you do more trading. Again, you might have higher fees, and again, you might have, and this is the big reason in my view, you're going to lose out on those risk premium. And these reversals in valuation typically occur not over 1 to 2 years, but often over 5, 10, or even 15 years. For example, I would describe myself as a value investor. Most of the portfolios that I have for clients are tilted towards value stocks and use other factors as well. But over the last 10 years or so, growth has outperformed value by a fairly significant margin. And even this year, that's also happened, even in a down market. So I do a lot of research on this and study. Do I believe that the value risk premium still exists? Yes, I do. I do think there's research out that supports it, and I do think that value will come back. When it will come back, I have no idea. All right. Morningstar actually did an interesting study back in 2010, and it looked at tactical asset allocation funds, and it compared it to the passively managed, which is basically a strategic asset allocation fund called the Vanguard Balance Index Fund, and found that 64 of those 92 funds that were at least a year old, 70% underperformed basically the static, and the average underperformance was 2.6%. In an updated study a year later, only 17% of those funds had outperformed the benchmark strategic, so 83% underperformed. And there's been some more studies since then, and basically, if you look at the research out there, I go to a lot of websites where I look at research, including SSRN, Social Science Research Network, and there's a lot of papers published there about tactical asset allocation techniques. And one of the things I try to keep in mind is, anytime you see a research study out there, I'm looking for confirmation of that research from independent sources, and I'm looking for a large sample of data, not just something where data's done over 10 years or 20 years, because it's really easy in terms of finance research to end up with data mining. So you need a lot of out-of-sample testing. You need testing by others. I'm looking for basically 5 or more papers to support some investment technique without a lot of opposition to it in terms of research that doesn't support it before I even really get into studying the technique in any larger way. So you'll see a lot of different tactical asset allocation methods out there, hundreds of them. Can you ever disprove tactical asset allocation completely? No, you can't, because there's so many different ones out there. New ones come out all the time. But on average, tactical asset allocation underperforms strategic asset allocation. All right. Let's go into black swans and reducing the risk of those, and kind of an introduction to what's called the Larry portfolio. All right. Here's a nice little video about avoiding black swans from Larry Swedroe.
This book is for both professional advisors and individual investors that are looking to get a deep technical knowledge of how Larry, myself, and the folks at the BAM Alliance think about portfolio construction.
We decided on the title of Reducing the Risk of Black Swans because of the concept here. A black swan in finance is an improbable or highly unlikely event.
Really, this term, black swans, is something that goes back to the 1st or 2nd century from an old Latin expression. And really, the idea behind black swans are these are totally unpredictable events.
You might think of the events of September 11th, 2001, or the financial crisis of 2008, or the oil embargo of 73.4, which in each case caused stocks ultimately to drop roughly 50%.
And so that's what this book does, is how to build a portfolio that can withstand black swan events that nobody can predict.
So we showed the reader here how we use the science of investing to build more efficient portfolios.
Now is a great time for this book, particularly because of the trend that's been going on in the industry around what's called smart beta strategies. And these are really any sort of strategy that includes a factor tilt in the strategy. That could be a tilt towards small cap stocks, value stocks, momentum stocks.
We've also used that same type of strategy in a different way, which is instead of trying to raise returns while keeping risk the same, we flipped it on its head, and we've used it to show how they can keep their returns the same but lower the risk dramatically.
It's been sort of strange for us to see here at the BAM Alliance this industry trend moving towards tilting to small cap and value when it's something we've been doing for going on 20 years now. And so that's what this book does, is how to build a portfolio that can withstand black swan events that nobody can predict.
I think one of the nice things about Larry is not only he's a very effective communicator of things. I was privileged to have lunch with him here at the beginning of March of this year, and we discussed a lot of different concepts in a very short lunch, about an hour long or less, and it was just such a pleasure to hear him convey concepts in the way that he does. Here's another video that explores can you insulate your portfolio against major market conditions?
Hello again, you're watching Sensible Investing TV. Investing is inherently risky, and every now and again an event occurs which takes investors by surprise. For example, 9/11 or the financial crisis of 2007-8. The scholar and statistician Nassim Nicholas Taleb has referred to such events as black swans. So how do investors minimise the risks these events pose? Well, a new book claims to have come up with a solution. It's called Reducing the Risk of Black Swans, using the science of investing to capture returns with less volatility. It's written by Larry Swedroe and Kevin Grogan from Buckingham Asset Management. We went to Buckingham's headquarters in St. Louis, Missouri to meet the authors. So we asked Kevin Grogan, how can you dampen risk without substantially reducing expected returns?
The way we attack that problem is by taking the stock side of the portfolio or the equity side of the portfolio, overweight small cap stocks and overweight value stocks. But then we reduce the amount that is allocated to equity overall. So let's say you have a portfolio that's 60% stocks and 40% fixed income, but that 60% that's invested in stocks is invested in the total stock market. So you own all of the stocks in the world. Another approach might be let's invest 40% into stocks, but then overweight those stocks to value in small cap stocks, and then have that 60%, the other 60% invested in fixed income. And with that approach, you're maintaining that same expected return because you're lowering the amount that's invested in stocks, which have higher expected returns than bonds, but then you're supercharging that equity allocation by tilting towards small cap and value.
A helpful way of looking at expected returns is like this. Say the average expected return is 7%. Well, there'll be some years when returns are disappointing and fall to the left of this graph. In the good years, returns will fall to the right. These sections here are called tails. So effectively what Swedroe and Grogan have done is to design a portfolio that reduces the length of each tail. It minimises the risk of sharp falls in the value of your portfolio in exchange for slightly lower expected returns.
That allows you over the long term to get about the same returns, but cutting the downside risk dramatically, which is particularly important for people who are in the wealth preservation stage, and also retirees, because drawdowns in the early years of your retirement means that it could be difficult for your portfolio to ever recover because you're withdrawing the portfolio. So when the market recovers, you don't get the full recovery because you've spent that money to meet your living expenses. So it's key to be able to reduce that left tail risk. And this portfolio strategy of what we would call a low beta, meaning low exposure overall to stock risk, but then a high tilt, meaning lots of exposure of the equities you do own to the riskiest small value stocks, allows you to achieve this objective.
Of course, there's no such thing as a perfect portfolio. If you're a young investor, for example, or if you're relatively relaxed about risk, you might well consider the low beta, high tilt approach much too cautious. But it will appeal to many risk-averse investors who are disciplined enough to stick with it for the long term. A reminder, the book is called Reducing the Risk of Black Swans, and it's by Larry Swedroe and Kevin.
And that's a book that you will be reading in this class. You should look forward to it. I think this is one of the best short videos explaining basically a core component of this class, which is not only understanding investment concepts, but also understanding how to minimize risk in your portfolio with something called the Larry portfolio, or some way of adapting that. So let's take a look at 2008 bond funds. Well, you know what? If you were invested in U.S. Treasury funds, an intermediate term U.S. Treasury securities fund, the price actually increased in that period of time. If you were invested in an intermediate term bond fund, which invested in corporate bonds, the price actually fell, and high yield corporate bonds, basically the below investment grade funds, below investment grade bond funds, fell by 25-30% in value. Significant drop. What you find is that corporate bonds are not favored when there's a severe economic event going on, like the Great Financial Crisis, or what has happened in the last 2 months here. We have actually seen corporate bond prices fall somewhat, even though interest rates have come down tremendously in a very short period of time. What has done well is the yields have fallen in terms of Treasury securities significantly, but if you were owning like an intermediate term Treasury fund, you would have seen an increase in price just this past year. Another concept I want to explore is, even when you're talking about these factors, valuations matter. All right? Just because U.S. small cap value stocks are highly likely to outperform over a very long period of time, or some of the other factors that we studied, the investment factor, and momentum, for example, and the profitability factor, the equity factor itself, we always begin with valuation to try to determine, or at least estimate, the expected returns of asset classes over the very long period of time. And now, the data that I use here is data that I have compiled from Russell Index's data over a very long period of time. They're not 100% accurate, they're pretty close, but what I do is I take the average price to book ratio, and remember, price book is only one way of determining valuations of individual stocks and or an index of itself. And I look at large cap growth. Large cap growth stocks have a higher PB than value stocks, and also small cap growth stocks have a higher price book ratio on average than small cap value. Generally, large company stocks have a higher valuation using price book than small cap stocks. Again, that's a reflection of both risk, and there are also some behavioral finance explanations that might account for that. And I compare these averages to, in this case, March 16th, 2020, which was earlier this week or last week. And I took a look and I found that U.S. large cap growth stocks remain significantly overvalued, but all of the other asset classes are basically undervalued. Not statistically different here in terms of large cap stocks overall. Here you have an overvaluation in growth, an undervaluation in value. Overall, large cap balanced stocks, perhaps represented by the Russell 1000 index or the S&P 500 index, actually appear reasonably valued at this point in terms of their using price book ratios. So what we find though is small cap value stocks are the price book ratio has fallen fairly significantly. It's not the low point of price book ratios. It's the low point in recent history is actually down around 0.57, I believe, somewhere in that range. But small cap value stocks are selling for less on average than their book value, which is a nice thing to see. So how does this translate? I actually use this to estimate future returns, not for purposes of tactical asset allocation, but rather for purposes of predicting the long-term future returns of my clients' portfolios and how that affects their financial planning and their retirement planning. And so what I do is I take the Farmer French indexes, all right, and then I make some adjustments to that. Now the Farmer French indexes are much more heavily tilted, if you're looking at value stocks, towards value, or small cap, much more heavily tilted towards small cap. They break the market into basically three slices to determine this, as opposed to a lot of indexes that just split the market in half, value versus growth. So you get a much more concentrated value risk premium and small cap risk premium using the Farmer French indexes. And there are mutual funds that I wouldn't say track these indexes, but use the same strategy as that index. And I then make an adjustment for lower inflation compared to historically, because when you have higher inflation, typically stock returns also tend to be higher. I'm projecting lower inflation over the next 15 years, so I make an adjustment for that. It's a pretty significant adjustment. I also assume that prices will revert to the mean. So if something is overvalued, such as large cap growth stocks, I'm going to assume that at the end of a 15-year period of time, that price book values go back to what is the average. Now, there are some reasons to think that price book values have gone up over time. There are a lot of reasons for that. One is basically how you categorize goodwill and how you write that off over time. Another big reason is that in today's U.S. economy, we don't have a lot of capital intensive operations like steel mills as we used to have, and other manufacturing enterprises that had a lot of assets to generate revenue. We have a lot more technology stocks, a lot more service industries. We have a lot more basically this basically says that price book ratio should be higher, and we also have companies that outsource their manufacturing operations overseas, like Apple does. So it doesn't show up even in companies that produce some of the products. They outsource some of the manufacturing. So when I'm making an adjustment to the reversion to mean, I do not take that into account. So we typically, for a lot of these asset classes, we would tend to think that, hey, price book ratios actually ought to end up higher, but I don't take that into account in doing an adjustment for reversion to the mean. I do tend to do some additional adjustments for economic risk, lower premium risk, and the like, and that's a fairly significant adjustment as well. And when I make all of these adjustments combined, I come up with an estimated future 10-year average return. And I come up with U.S. large cap growth stocks returning, a little less than 5%. And then U.S. large cap stocks about 7.4%. And then small cap balance, small cap value stocks doing particularly well. Now, these are estimates. These are not guaranteed by any means. In fact, the range of possible returns is really quite broad. There's absolutely, for example, no reason to think that, hey, at the end of the 15-year period, stocks might be really undervalued and maybe the economy over the next 15 years does really lousy and all of that. Basically, all the bad stuff happens and we might see, in fact, negative returns across the board. But in terms of the most probable outcome that I see, this is basically what I'm coming up with fairly conservative estimates of what I think the returns are going to be. So notice that the Farmer French Indexes has a 14.3% from 1960 to close to the end of 2019 in terms of small cap value. I am only predicting a 12.5%. So relatively conservative compared to historical. But again, a big adjustment for that adjustment here is the adjustment for lower inflation that I'm assuming occurs in the future. So just to apply these concepts, let's say you own the entire U.S. stock market. You would probably have about an 80 to 85% allocation to large cap stocks, about a 15% allocation to small cap stocks, and we might consider large cap to include mid cap in this case. The expected return of large cap stocks 7.4% according to the projections I did. Small cap stocks higher. Fixed income investments 2%. We don't have any allocation of that in this chart. And then we combine these, so we multiply 0.85 times 7.4, we get the contribution to the portfolio's returns, and we get an expected return close to 8% for this portfolio, which is basically investing in the entire U.S. stock market over the next 15 years. What is the rate of return that we're going to see? Now, a lot of people can't take 100% allocation to stocks, and in fact, even a fairly young investor may not take that. So what if we do this? What if we allocate 20% of the portfolio to high quality short-term bond investments that only have an expected return of 2%? But then we do a huge tilt towards small cap and a huge tilt towards value. In fact, we put most of our funds in the 40% allocation to small cap value. Here are the expected returns that I did previously. We figure out the contribution to portfolio. And what do? We get an expected return that's virtually the same. Statistically, it's not different. It's close to 8%. But we do that with a portfolio that has a lot less risk associated with it. In a Great Depression, we might conclude that small cap and small cap value stocks are likely to fall more than large cap value. But that's going to be more than offset by the fact that you have 20% in high quality fixed income investments. So this portfolio will perform better during significant market downturns. I've tested out similar portfolios in other stock market downturns. And on top of that, we'll also have a portfolio rebalancing bonus if you rebalance between the different asset classes, and that can be as low as, for example, 0.2% over a 5 or 10 year period. It can be as high as maybe 0.9%, depending on what your asset allocation is. If you're 50-50, it's going to be towards the higher side, and if there's a lot of volatility in the stock market, it's going to be towards the higher side. Otherwise, it's probably a good idea to assume that it's a little bit lower. We don't want to forget foreign stock markets, so that ought to be part of our portfolio. Emerging markets, again, are somewhere between 10 and 12% of world market cap. And there have been a lot of underperformance of emerging stocks over the last 10, 15 years or so. The emerging markets value stocks in particular are very reasonably valued, but also more volatile, and in a Great Depression, there's more risk there. And foreign developed markets, we don't want to forget them too. They play a big role in the portfolio, having stocks from, for example, Western Europe, Australia, New Zealand, Japan, other developed markets around the world. So you got a lot of different asset classes that you could have. Here are just some of the typical asset classes. To these, we could add other factors. For example, we might have a small cap value fund that also adds the profitability factor or the investment factor into it. So when we do that, we can actually end up with multi-factor funds, and some of them invest in the broad market. They basically own the entire market of stocks, but they tilt towards these factors like small cap value and high profitability companies. Avantis, uh, the earliest really uh, great fund company that did this is Dimensional Funds Advisors. They have some competition in the market from Avantis, where basically a couple of the portfolio managers from Dimensional Funds, the head of the research or the investment committee actually went and formed a separate fund and has recently started, and it's definitely worth a look. Compared to dimensional funds, and you really have to do some deep research there and compare the attributes pretty quickly. You also have a multi-factor funds, several of them from Vanguard. On the international space, you have dimensional. You also have some Advantis core equity funds in the international space, and iShares has come out with some multi-factor funds. So, and including a world fund where basically 50% U.S. stocks and then stocks from other countries as well. So you can actually get one fund that basically invests in the entire publicly traded stock market, at least, yeah, just pretty much everything. All right. But we also have to observe some other secrets in investing that we'll be studying later. We have to keep our fees and costs low. It's not just the fees and costs that you see, like the annual expense ratio or commissions. It's also transaction costs that can occur within funds due to trading that occurs. We need to keep uh, tax efficiency. We want to use tax efficient stock funds and taxable accounts. We want to place our different asset classes in the right type of account. For example, Roth IRA accounts versus traditional 401k accounts versus a taxable account. We want to broadly diversify. And remember, we always want to keep that international stock asset allocation somewhere between 30 to 50% of our total exposure to the equity markets. So these and other secrets of investing we'll be exploring along the way. Now remember, however, the focus of your reading is how to counter behavioral biases. And yes, oh my gosh, the bear is getting furry. All right, I'll leave you there. Enjoy the class preparation assignment. And again, if you have any questions, feel free to call me or email me or text me at any time, as long as it's before 9 o'clock, because you know I want to get my 9 hours, 15 minutes of sleep. Thank you.